The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour, 11 o'clock till noon, Monday through Friday. And this is a fascinating market. Consolidation taking place, but very narrow. Right now, you've got the E-minis, which were down a few points, now up 50 cents. The 2062, this is really an interesting pattern because it's like a W pattern, trying its best to get towards the 2095 high that was made way back. 2095 was on the 18th of August. It's got this trend line resistance. It's got the support at 2038 for the 9-period moving average. Weekly chart looks good, but the technicals have to catch up. And the 120-minute chart had that rectangle formation, which can last a lot longer than your patience as it tests support, broke it by a tad, then quickly ran back. So you're in the rectangle formation in the 120-minute chart. Let's move that away and let's run the numbers because there's a lot to look at here. A lot of earnings coming out, have been out, etc. So here we go. In the there we go. The Dow is up less than a point. Is at 17,623. The S&P is down 2.22 at 2,068. The comp index is up 2 at 5,036. You've got bonds. Bonds are up 20, 30 seconds at 158 and 20, 30 seconds, and that's really quite good, especially with the TLT at 124.49, up over 40 cents. This is just saying that the market correction should continue a little longer. How it holds support is going to be important. How it can break out is important. We'll go through that in a moment. But let's just look at gold down a fraction, 1166. Silver up a penny at 1592. Platinum's down 5 at 990. High-grade copper is at 2.36. It's in this area. It's been there for a while. Crude oil is down 87 cents at 43.11. And the dollar, let me just put the dollar up right now because the dollar is continuing to be quite important as it rebounds. Nice action. It's at 96.90, up 4 cents. It needs to take out 97.20, the high of 3 days ago. The moment it does that, I have to consider that's a leg C. And that says that you're going to challenge that whole area in the 97s and how it takes out that dashed line trend, that gray trend line resistance in the weekly chart at 97.20 going to maybe 97.40s. That's going to be very important because if it does it this week, it's starting to improve not only the pattern of the daily, but in turn it'll improve the weekly chart pattern both technically and price-wise. And it's going to then confirm that the rally that we've seen with the sideways movement, but holding above the 9-period moving average, that big, thick black line in the monthly chart, this one right here, holding above the 9-period moving average since it broke out in July of 2014. It snuck below it this month, last month, and the month before. And that August low of 92.62, we were very much 4 points, 5% higher from that. This is so far the monthly chart with just a few days ago is really looking very good. And that means we can look at the EUR USD and say, broke support, doing exactly the opposite. The weekly chart is starting to form what looks like a much larger arch formation. And I can get rid of that because that's not working. So let's just take away all the unnecessary. So that could still pan out over a period of time. I'll put it in. Very large cup formation. The confirmation says you could still decline in the euro, and you could a euro-dollar currency pair. You could even decline towards the 1066 area, and it's at 1.10 without breaking the trend. Well, the major trend is still down, but without breaking the arch formation consolidation. USD JPY, I was asked if I could show that. Certainly could. That, you see, I had looked at up until 5 or 6 months ago the parallel movement of the US dollar to the Japanese yen as it relates to the actual dollar index chart. And basically what I'd said was that there was a pattern that is very similar. As long as the dollar's going up, the USD JPY should also move higher. Then all of a sudden, you got a divergence as that really sharp. Remember, this had to do with the economy and what was done in Japan. But back in August, the 24th low really smashed the USD JPY lower, and it went all the way down to 116, trading now at 120.41. Then you got that rectangle sideways move that got narrower and narrower, with a little pop-up 3 days ago to 121.466. And now you've come back down. And all I can say is that this pattern, the rectangle sideways pattern, can last a lot longer than your patience. 119.6 is the support in the USD JPY, and a breakout will really not be just a move above the 121.496 high of the 26 yesterday. It really needs to hold. It needs to get there and then close towards the 121.70s, and that'll say, oh, okay, now we're back in trend, not in pattern, but in trend of following the dollar. Okay, now we've got that out the way. Let's run a couple of things. Yesterday I'd written down a whole bunch of stuff, and I forgot to look down at the page because there were so many questions. Let me do that now. Okay, I was asked about... let me get in order. Okay, let's just do this. I was asked about the KRE, which is this is the financial sector, but it's the SPDR S&P regional banks. Now, I was a little surprised to find that my notations were not here. I don't know how that happens, but anyway, it's okay. Oops, that's not an error. Let me just put this. This is an A, B, C, and then it sort of fails. And then it goes to right there. So I'm going to restart. Now I'm going to do this. I'm going to do just very traditionally. A, I'm calling this B, A, B, C. This is now the monthly chart that I'm doing. C, D, in the Chapman wave, I'm putting the notations. E, and then it goes to an F. And then the big question, we've seen this in a number of charts, the last rally, that August 24th low of 35.01 took out the low of 35.20 that was made in October of 2014. So basically, we have to look at this as if that was a G, and now we've restarted and we moved to the upside. So let me just make it as simple as possible. SPDR S&P Regional Bank, trading at 42.85, down 5 cents on the day so far. Monthly chart looks to me as if over a period of time, as long as it could get into the 43.30 area within the next, say, week, then that inverted candle of September of 2008 with a very high spike, 49.58, and then a close way down near the low, says that candle's wick, the halfway point, around about 42.20, which is exactly where we are right now, that 42.20 area says if there can be trading for a whole month that turns the 442 area into support, and it starts to make even just nominal new highs. You don't even have to break into an all-time high of 45.63, a recovery high that is. Just has to move up there. And that's going to make it a very attractive candle to watch for over a period of time. It's just a goal that would be in the future. Now, on the downside, you've got the wick that you got to watch. So a close in the next 3 weeks in the KRE, this regional bank index. I don't know how it can do that, but if it does, and it closes under 38.20, that's the 200 period moving average in the monthly chart, that's going to be very negative, and it's going to suggest the 35.01 low of August is going to be tested. At this point, I'm putting more emphasis on the upside potential if you can get 60 to 70 cents higher in this KRE index over a period of, today's only Tuesday, let's just say Friday or Monday, somewhere around there, you should be testing somewhere in that area, just in the upside. Because if it starts to arch over, then that rectangle formation says, uh-oh, forget it, you're in a trading range, you're going back to the 40 area, 39.50 to 40 area, and you're just going to stay there for a while. So this is kind of an important moment for many of the different indices. So we're going to go to our first caller. We've got Mark in Fort Collins. Mark, how are you?
Good, how are you?
I'm well, thank you.
All right, I'm going to give you a little grief here.
Yeah, please.
Okay. So I've been watching the XLV. I know that I didn't take it because I wasn't convinced of going short that. It looks like the stop got taken out.
It did today, yes.
And so, and my question for you is, why didn't you wait for a peak D from the low on 928?
That's a very good question. And I'm going to explain a couple of things. In fact, it gives me an opportunity to go through the same pattern that I've seen in a number of charts, and okay. It's a pattern that gets repeated over the years. I've seen it hundreds and hundreds of times. And my thinking was this, that we're looking at the XLV. This is the S&P Select Healthcare Spider. And whenever coming off a bottom, there is a distinct peak A to a peak B, and then the B or the C fails and actually takes out the low that was important. In this case, my low was not the spike low to 56.63. It was really the series of lows that made the, like the September the 4th, 68.18 level, a support area. And in fact, what happened is the XLV went down to 63.73 on the 28th. That's with that big turnaround in the market. Then I thought, well, we've got a peak A. We've got, oh no, did I just miss something? 69.02, 69, I can't believe it. This would have been a D. My thinking was, I didn't see that, and my thinking was that I had seen a peak A and a peak B, and that there should be another C minus.
Gotcha.
That was my thinking. So I can't believe it. I just had too many lines there, and I don't usually do that. I did miss that peak that was made for peak B on the 13th of October at 69.19. So now what we've done is we've actually climbed to a leg D. So my thinking, let me just get to this before we got the break, is that I thought I'd see a series A, B, C minuses, and that this would have been a C minus. That was my thinking. Now, the fact that I missed the peak, it actually comes to almost the same conclusion, and turns out now that I've got a D, but at the 200 period moving average. So we'll talk about it when I get back, okay?
Okay.
If you're looking for a great opportunity to diversify your financial portfolio and hedge against the falling stock market, consider the new market-safe Metals Hedge CD from Everbank. This 5-year indexed U.S. dollar-denominated CD gives you exposure to metals with gold and silver components and allows you to hedge against falling equities with a short component on the SPY ETF. You can earn up to 45% capped upside payment at maturity if gold and silver increase in value and the SPY ETF decreases across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Don't let fallen markets get you down. Get the Metals Hedge CD. The November 12th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. So we're back, and we're on with Mark and Ford Collins. And hi, Mark. And we are looking at XLV, and it's up 105. It's at 70.65. I've drawn in an up channel. And that says that two things are happening. At 70.66, it's very close to 70 point. Is that 82? Let me just double check. 72, that 70, 92, 200 period exponential moving average level. And this is always for me one of the big challenges. And let me explain what I'm looking at here. The fact that off a low, it's gone to a peak D rather than a peak C failure says to me there's more internal strength, at least that I expected at this particular time. But it is certainly way off. It's 10% off its 77.40 high of the 24th of July. And it has already gone from 77.40 to 56.63. That's almost a 1/3 decline. When I look at charts like this, I say, okay. And this is what I did almost all weekend. I kept looking at the charts and saying, have we in fact, under other circumstances, if I was just picking up this chart for the very first time, surely I would say to myself, hey, wait a minute. This has just dropped by 1/3. And now it's come back to just over 50%, nearly 60%. Hey, is that the conclusion of the down move? Now, in some cases, I've come to realize that the August 24th, I call it an aberrational low because it should have gone sharply lower at the opening. But in fact, what happened is that the futures went down 500 points before, and then 500 points out of the blue, like 10, 15 minutes after the opening, because of the electronic trading. And that said to me, okay, is this like the flash crash, where many of the charts of the flash crash, you should not do this because in technical analysis, the price is the price. If it was a computerized thing, it would look back and see 56.63 is the price here, at the low of the 24th of August. And in May of, 2011 or 12, those lows that were made were almost the same thing. You have no idea who got those few shares at the low of the day when it turned around 1,000 points and ran up. Now, what's really important is that I then took it upon myself to say in that May crash that I exited out in my charts. I just said, I'm not taking that as a low. And in some cases, in fact, we were short. In my opening call, we were short like the 200% short. And we lost money because they did such crazy things that they had the short go up instead of, the short went down instead of going up at some point. I don't know how they did it. And in fact, what happened was what should have been a massively positive trade turned out to be either I can't remember now, slightly negative or just a very little profit. And that's crazy. So I'm looking at this and I'm saying there are signs to me that say I have to reassess, and I've been doing that, the August the 24th low. Now, the reason why I'm giving you this preamble is that if you look at the chart, 1/3 is really a very big correction. It's almost a correction of the size that says maybe we're already done with the correction and now we're going to go back to the upside. See, do you understand what my thinking is here? My thinking is that if it was that Monday had nothing, it was like the flash crash that in May of whatever year it was, that there was nothing really that precipitated in bad news, and the bad news should have been building up towards that low, like the crash in October the 19th of 1987. It was a 6-week, it wasn't a crash, it was a 6-week decline. 500 points to the Friday before, down, and then 500 points, bam, that one single day. So that's different. There wasn't that kind of bad news lead in, even though it was July and it was August that we made the low. So that's just 2 months, but it is a certain period of time. So what I'm saying is that in my analysis, I'm trying to put this together to say, what are the areas that regardless of whether that was an internal low and there has to be a residual low, what would be comparison to say there was an internal low and now there should be some kind of residual low fairly close to that area, which would say you could take it down to 60. That has to be a really bad series of ugly news coming out of the economy and the market takes it very badly. Or I have to say, you know what? What if you're done now with the XLV crash and now it just goes sideways to maybe up? So do you have time or should I? No.
Yeah, I just want to point out one thing when you come back about where I'm looking to short it, so we can talk about that.
All right. Okay. So I'm going to talk about the exact scenario that you're precipitating now. I'll be back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. So we're on with Mark and Fort Collins. And what I'm going to say, Mark, why don't you give me your analysis here that you're looking at? I've got mine clear to say that this whole area of the 71 to 72.5 area is going to be strong resistance. But tell me what you're looking at.
That gels right with where I want to go short, and I'll tell you where I'm looking at. I'm looking at so I'm using a few of all of your methods here. So it looks like we're doing an ABC up from the 928 low. I'm measuring that up to the 1005 high, which is about 530 as far as so. And then I take the low of 1006, 6591, and so you add 530 to that, and you get like 7120-ish.
Okay,
area.
That's right in the area, right?
Okay, and then if I take a trend line off the top of 1005 and I run it through the high of 1019, draw that trend line going up.
Okay, right.
And so that intersects kind of if the next leg up, if we do make another leg or this leg continues, that's somewhere that intersects with a trend line coming down off of the 805 high of 7726. I drew a line from that through the highs of 818 and 819.
Okay, all right.
Which is just about a week later, it looks like, a week and a half later. and that comes down. That intersects exactly with that trend line going up from those other highs that we just talked about, and that intersects right at about the same level, right in the 7140, 7150 area. That's kind of similar to those trend lines intersect with about where the ABC up should end.
And also the 200 period SMA, that's the simple moving average that most fund managers look at, would be at a 72.57 area.
Yeah,
so that's the resistance.
I was going to scale in some short put positions in the 7150 to basically 7250 area. If it gets that high, maybe even.
Can I make a suggestion?
Sure.
I don't want to change your thinking.
Okay.
But you might want to start, even if it's just one, because peak C, leg C up in the 120-minute chart.
Right.
So that's saying to me that anywhere in the 17.80 area, so that's like 15 cents away, you might want to just start one put right now, just to kind of, it doesn't have to be right. It just has to be a starter position, because the market, I still feel, is quite vulnerable right at this moment. So we might find that, in fact, there's a gap down tomorrow, because Gilead, you see, this is what I was thinking. Actually, I'm going to revise that just a little bit. I want you to, just take a moment. I want to show you, if you're looking at the charts, this is the makeup of the healthcare spider fund. Johnson & Johnson doing really well. It's at 100.56. It's up, but it's just about to get to some kind of resistance at a peak F. It could recycle, could go just a tad higher. But there's a lot of evidence that says close. It's not at, but probably real close to at least some kind of sideways pullback. Pfizer's next PFE. Pfizer's made a gap up to leg D in a doji candle, says be careful here. It doesn't mean to say you're going to have a sell signal, but it does say the way it handles the gap in the next 2 days is going to be very important. So it's a little bit vulnerable if Gilead, which I believe comes out with earnings today and up $1.44, if for any reason it disappoints, then that will trigger some of the other, and there are not that many biotechs in here, but there are a few. And that would suggest that you've got anything like Thermo Fisher Scientific, you've got Abbott Labs, Express Scripts Holdings, you've got a whole variety. There's Stryker, that's the hip, I think, replacements and all that, Humana, and Boston Scientific. So you've got the medical area, MDT, Medtronic, as well as the healthcare, the products areas. So I wouldn't get too carried away to look at the put side, other than to maybe just nibble on a position now to give yourself a little bit of a starter position if it does start to slide. But what might happen, and that's the thing that I wanted to talk about, I'll talk about it when we're done, because I want to relate it to some other things, is that the move that we've just had might be a move that is continuing the consolidation. This is my assessment now, that the August low might not be taken out at this particular point. It might have to wait for a while, and that we might have to go sideways. And my recommendation was that maybe on very sharp sell-offs, when you've got your put positions, you take some off, because you're going to have a chance to, on each bounce, if it is only a consolidation here and not the start of the rollover to the next move to test the downside, which is what I was thinking. And now, because really yesterday's move and today's follow through says to me there's enough internal strength in the mix of the actual sector itself, the components, that says that a move to the downside might be ameliorated by the defensive stocks like a Johnson & Johnson, like where was it down? Express Scripts, that sort of thing might hold it up a little bit. So that's why I'm saying maybe don't get too carried away. I'd rather wait for the rollover, and you can actually add to your position on the rollover down. But initially, think of it as taking money off the table and then putting it back on bounces as it just goes. At least at this moment, it might be telling us that sideways is going to be the action, because it's already dropped a third, and it just needs to recoup some of that energy and then expend that energy by trying to go higher. And it has this limit in the 71s. I just wanted to give you that. That's my thinking.
And do you think now that the IBB has actually made a leg B from its lows, it made a leg B today from its
A leg D, but the same as the XLV, leg D. It's not a great move.
No. I thought it was a B from the low. If you start over.
Oh, I see what you're doing. No, I've taken, in the Chapman wave, this is something you might want to do. I've got A minus on the 5th of October, and then we've restarted with an A and a B and a C and a D. So today's actually D.
Ah, gotcha. Okay.
See, and I was looking for 322s to start looking to see how it handles that. So we haven't added any position to the short side in the IBB. I think there's still a little more room, and that's the reason why I'm saying be a little careful, because we're looking at other sectors. A sector that I was in, and we made some money, and then I gave back by a fraction yesterday, is now down again. That's the restaurant area. So look at your sectors, and I think the restaurant area is starting to go down. I'm waiting for the auto parts to give that signal, and they haven't given the full signal yet, but I think we're real close. So here's one that did it, and now you've got to be a little patient. Sideways moves can cost you a lot of money, as I'm just finding out now by shorting when it was actually really a sideways move.
Okay, thanks, Basil.
Thank you for calling, and good questions. Let's go to Greg in San Mateo, California. Greg, how are you?
Well, thank you. How are you?
I'm well, thanks.
I have a question on the USO. I have a position short the USO in another ETF, and it looks like it's in, I have it counted as a leg. I don't have it in the 120 right now, but I think it's still F in 120 and C in a daily. And so I was looking for a retracement back up in the USO, and I was wondering where I might be able to add to my position.
So, okay, now this is a perfect opportunity to look at it, start preparing yourself. I personally wouldn't do anything right at this moment, but I think you've got your eye on something that might be percentage-wise, not a big turnaround, but percentage-wise. Why? Because the Fed's going to come out with a statement on Wednesday, tomorrow. And I've got a feeling that it's going to do a little shaking up of some things. And maybe this is where the big test is coming for the dollar. And so far, the way I see it, the dollar's acting really well. It looks like the bias is to the upside. So the preparation here is not to do anything just yet, but to look at the USO. You might give up some points, but if tomorrow at 3 o'clock you start to see the dollar pull back instead of rallying, I would grab the USO at 13.77 right now. You might get it because it's turned around and it's already at 13.93 or maybe even 14.10. What I would do then is I would be prepared. It's almost like you want to buy. It's almost as if you put your buy entry point a little higher rather than a little lower. Do you know what I mean? So what I'm saying is the USO is not either it's going to fail completely tomorrow, so you don't really want to. You don't want to be buying a decline, because this is, we used to have someone in the den that always used to say, get out your metal gloves because catching a falling knife is not a pleasant experience. So
right, I'm sorry, maybe I didn't. I'm looking to go short.
Oh, the USO. You're short?
Yes.
Oh, you're thinking,
I'm
okay.
sorry.
So you're looking to see whether or not it's going to retest the left side low in the 1237 area or break it.
So I apologize. I use the USO, but I'm short the USO in another ETF, so I didn't explain that very well.
Okay, so you're already short, but you would add to your position, and okay. So this is the exact opposite of what I was saying. What you want to see is if I'm not sure it's going to happen, but this is the opportunity to see that this is the case that it could happen. And that's after the Fed announcement. If the dollar starts to spike, it's a little tough to do it immediately because sometimes you get the spike. That isn't always the direction that half an hour later the market's going.
Yes.
But I know that you've watched this probably enough times to know exactly what I'm talking about. So this is what I'm going to recommend. You don't want to be in. The question is, should I buy it now in anticipation? And my answer to you is, that's a very big risk, because let's just say you short it now. You want to short the USO. Would you be going, is it the SCO that's the inverted?
That's
So I'm looking at, you see, The SCO is made A, B, C, and that should go to a D. So I'm kind of in your camp right now that the dollar probably will strengthen and the oil will go down. It's just the risk that you're taking. I don't know how you want to treat the risk. So let me just put it this way. If you would you actually short the USO, or would you be buying the inverted short? Would you'd be using the USO?
The inverted.
So
yeah.
Okay, if you're going to use the USO, then probably what I would say to you is hold off doing anything. But if the dollar suddenly spikes, then you want to be able to grab the USO, and preferably it'll be above 1361, today's low. But now I have to ask you the question, what if by the time you want to do it, it's already at 1354? It's getting real close to your 12-something target. Would you still do that?
No, not at that point, because I already have a position. I already have a position short. So
I don't want you to aggravate your good position by doing something that I would consider dumb, by taking a real quick trade that in a split second takes away 10 or 15 or 20 or 30% of your profit. You know what I'm saying?
Yep.
So there's another way to do it. And that is, at this point, instead of a bigger position, you just take a small position at 1375. You short it at 1375. You're going to have really quick fingers, but you can do it. I've done this before. And as it's unfolding, if the dollar spikes, you will see a quick move up in the USO, and you're just going to have to be real quick-fingered to cover your short as quickly as you can. I don't know how else to put it that way. What you really want is to get your position at 1374. Tomorrow at this time, it's trading within 15 cents of that. It hasn't done much. It's just waiting. And as the news comes out, it slams down, and it's at 1350, and you can say, okay, now I can put in I can cover at my entry price. I can quickly take a profit because there's a quick trade. You know what I'm saying? You're in it. So that's the only way I could do it now, because we don't know which way it's going to turn. My guess is that you're right, that it's going to try to test the left side low. But at this particular point, I'm also going to suggest to you that sometimes trying to take a quick profit can turn into a quick loss. So maybe you've been so patient up until now, it would be better to get the dollar screaming to the upside, and you know that you can then add to your USO position on any bounce in the USO in your own time, in your own comfort. You've got the trend right. You're just going to be adding to it. So this is just purely money management, and my suggestion is if you can have a little patience and give up a potential nice gain, it's also saying, you know what? A friend just said to me a few moments ago, what did you say? When in doubt, leave it out. I said, hey, that's a good expression. I should use that in the market. So here you are. When in doubt, leave it out. I think it's better. It's safer. You've done such a nice job of getting into the entry point with your USO. I would say be happy that it's going. And if it goes your way tomorrow, that's even better. And if you can do the quick trade, you can always add to it. But don't put yourself in a hazard. Good. Hey, thank you so much for calling.
My question. Thank you.
Thank you, Greg, and congratulations. That's a good trade. That's Greg in San Mateo, California. We'll be back with Robert in Chicago straight after this break.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. We've got Robert in Chicago patiently waiting. Sorry, Robert, I skipped you by mistake. How are you?
I'm very good. I was looking at Northern Trust. What is your 6-month, 12-month view on NTRS?
So NTRS, Northern Trust, trading at 69, round number right now, up 10 cents. This is a bank?
That's right.
Okay. Is this a regional bank?
It's a trust. It's a trust bank. They'll run the pensions for CalPERS and a lot of different folks around.
Okay. All right. Good. Because I was looking at the chart formation, and it has a much steadier one than many of them.
Is it BNY, Bank New York, Mellon, or they do the
BK,
same thing as
yes.
them?
Because BK, isn't that interesting that you just mentioned that? That is such a coincidence, because did I mention this yesterday? I was looking at, I did a lot of work on Bank of New York Mellon, and before it was called Bank of New York, BK. I used to always chuckle, wrong name for a bank to be called BK, right? Bankrupt. But in fact, it's always been one of the better chart patterns. Whenever I look at the bank stocks, BK is the one, and now you've just mentioned BK, and the relationship in the daily chart is very close. So let's just go back to this. So your question is NTRS, going back to that. Here's my big issue here is, I think I typed in the daily chart, a rectangle formation can last a lot longer than your patience. In fact, I misspelled longer. When I looked up, I saw I put linger. And linger is exactly it. You see the H pattern that's gone to an M pattern, but it is making slightly lower lows and lower highs. My thinking here is that it's probably a very steady bank, that there is downside, and the downside could be 5 to 7%. When I say, okay, downside 5 to 7%, does that make the upside really worth it? Because am I looking at a 15 to 20% on the upside? And all I can say is it looks to me like Northern Trust needs more time. And if it's building up a base of support that could even slip underneath the one that we've got here at 63 something, if it go 65 something, if it can go to 64, 60, 63, I don't think that's a big deal. What I do think is a big deal is I don't know what kind of dividend they're paying. I don't know the other factors, but as a chart formation, it looks to me like it's got a little bit more risk in buying it here than reward. And as such, I'm just going to say to you, you know what? I'm going to recommend hold off. But I love the way it's building the base. And if you can give it another, what's today, Tuesday, if you can call me next week, anytime, Monday, Tuesday, Wednesday, doesn't matter. I need another 3 to 4 sessions just to see, is it trying to break into the 70 or is it going to retest the 67 area first? And that to me is the big question here. So I'm going to say, hold off. It's worth keeping your eye on it. I just don't think it's worth buying as a prize right now because the weekly chart says there's a little more to be done consolidation-wise, and the monthly says if it does consolidate, you've got to look at the candle of January where the low is 61. That's 7, that's 10, 11%. I want to see if we can just hold very steady for another week, making 66.5, somewhere around there, a base of support. And then I'd like to look at it again. Hope that helps you.
Thanks very much, Basil.
Okay, good. Thank you for calling, and good eye. Keep your eye on this and let me know. Thank you. So I had a couple of emails just during the break, and one was the question is, Julie says, you've had so many peak Fs, E's and Fs in your charts, in the monthlies. What does that mean? What that means to me is that I've got to be really careful not to get too carried away by technicals that are improving if the monthly technicals are not going to improve. So the shorter term, if they're improving, that's great. So I'll follow up on this tomorrow because that's a really great question. Another good question came from a statement, transportation and the XOI. You know what? I'll deal with that tomorrow. They're good questions. Keep the questions coming. I love that. Folks, stay tuned. You've got your Kevin Hinks coming up, Great Options Hour, and I'll be back tomorrow. And good program.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.